for each bar. So again, I love this a lot, and with that also comes, a more abbreviated version for each of the bars. So that's also great. A couple of questions from Doug, so let's address this right away. The volume. When evaluating volume effort, so let's make a distinction. Volume and effort are two different things. Effort is going to be looked at us as the difference between, let's say, volume number 2 and volume number 1, right? Between two different bars. And we're going to say that, okay, there is a huge difference in volume, so something like this. And we know that, let's say, demand has increased here. So we're going to say that the effort to the upside has increased. And I know that it's going to look the same. Volume's going to increase, demand's going to increase, effort to the upside is going to increase. But it's important for us to make that distinction that effort is just kind of like, a force behind the volume signature. It could be on the demand side, it could be on the supply side. And it's the difference of what we've seen as the force before to what is happening right now. And the question here is, are we recording the absolute level of volume or its relationship to the previous bar or even a series of previous bars? And this is a great question because, and we kind of addressed this already today to a certain degree. We are going to look at a couple of things. We definitely would like to understand the relationship between, let's say, a single bar and maybe another single bar, or maybe a series of bars that would show us the same type of action, right? So if there is sell-in, so we want to look at the increased supply signature, and then we want to see how supply is decreasing on the next reaction. So imagine that maybe on the one single bar, we could have a bar like this, just a big bar, and it's going to be to the downside. And then where we have more of the consistency of sell-in, right? So this reaction might have just, different bars. But basically, these are the same things. These are reactions. They just happen in a different way. One is happening on the climactic volume with the big move to the downside on a single bar. Another reaction happens on the series of bars. So therefore, what we want to do is we want to compare the volume signature in different ways. We could look at the absolute volume signature matrix. That's number one. We could look also at, let's say, the averages. We could look also at the consistency of the demand and supply. And by consistency, I mean that for multiple days, the price goes down and there is some selling. That's consistency. This type of selling, where there is only one bar that occurs, is not consistent. It could be just 1 day selling, 1 day reaction, and then big hands coming in, absorbing all of the supply, and then we are done. So there is no consistent selling from day to day, week to week. So those are the three things that we would be looking at. And we'll definitely discuss it more as we go through the exercise. Let's look at the second question. It's on the intention. On an upswing, is the intention is to suppress the resistance? Yes. This is always going to be the intention for the price to do, right? To overcome the resistance or to commit below a support. So this is the intention for a bar or a price. Now, CRO has intention to push the price back into the trading range. So let's say that we have a commitment to the upside, but let's say supply signature increases. So we are suspecting that CO is selling. So what is the intention by the CO? Well, obviously it's just to sell, right? So to get rid of the position or to short the position, short, hedge, exit, scale out. So those two intentions, Doug, are completely different. One is just for the price. In the first case, we just want to see the price committing above the resistance or below the support. This is just price related. In the second case, the CO's intention could be different at the point of the resistance. It could be to sell, to short the stock, to exit the stock, to scale out, or to take some profit. It also could be different, and you're kind of describing it in the next question, is where we could have that increase of the supply on one bar, and then there is some kind of absorption that is happening through next bars. And then the intention for the CO are going to be different in this situation. The first scenario that you're describing is more of the distributional quality. The second one is going to be more of the accumulational qualities. But I think that the key here is just to understand that when we talk about the commitment of the price above or below the resistance and the support, the intention there is just for the price or for the specific bar. And then with the CO, it all contextual. What do they want? Are they selling? Are they buying? All right, great. Let's go to the next one. This is another example. This one comes from Rick, and I thought that was really cool because it just shows you guys that there is no discrimination to how you approach this work as long as you do something. And I see here a lot of something. I see that Rick has gone through this visually, manually, with the pencil, going through all of these concepts, labeling those, putting them in the way that he understands for himself. And that's what just excites me so much when I receive something like this from you. Yes, there are so many different ways of how you could go through this material, and all of them are correct, and all of them are okay, because it's just you. So just keep doing what you're doing, and I support you all the way. All right. Next couple of bars, quite entertaining, and those come from Lee. And this is the concept that we obviously have mentioned multiple times. This is the concept that I'm thinking, Lee, that these are, great slides. So I might have to ask you to incorporate some of the, into the course without me, creating all of that. But the concept here is the concept of the test of the supply. And the key here, and I'm just going to go really quickly here, but you guys can stop the recording and go as you go through the slides for this class. You could stop and just read this whole explanation by Lee, which I thought was really good. Look at the increase of the supply at 14. And we are saying with the increase of the supply, we should have a test of that supply. And we kind of seen that around 15, 16, 17, supply really went down. So locally, this is a test of the supply that came at 14. This decrease of the supply suggests that we are going to have a rally, which happens. But we also would like to have a test of the same magnitude. And that's why the current market is suggesting that we are going to have a reaction at some point, and that reaction is going to bring a lot of fear into weak hands. They're going to capitulate. Not only that, a lot of institutions are going to capitulate. They're going to take the profits that they've done in the last 2 months. And do you know that January and February are becoming one of the best months in the history for money managers? Why? Because in a lot of positions that those money managers are, even without adding to the position, those positions would produce such big rallies off the low of December 25th. And it just coincides with January, which is the first month, and it just produced such good returns. So they're gonna take some profit, especially when they're gonna see that the market's gonna start deteriorating, and imagine any bad news coming at this point. And then we're probably gonna consolidate, because that increase of the supply, like here, suggests that we're gonna go through the consolidation. It suggests that the supply needs to be tested again, and it needs to be tested on the same magnitude level. And sometimes the magnitude could be defined in two ways. Sometimes magnitude could be of the same proportional reaction, and in other cases it could be more of a prolonged consolidation action. So I think that we're probably going to see something like this rather than a much deeper reaction to the lows in December, just because of how rally is so, aggressive to the upside. That suggests that there was a lot of institutional demand, and as the price is going to go down, they're going to provide some kind of support, and they're going to see some value as the price goes down. So that's going to create some trading range that's going to be unfolding for quite some time. So that's kind of like one of my assumptions for the market. But coming back to schematic number 1 here on Lee's slide, we see that the same magnitude reaction into 21-22, even though produces a decrease in supply from phase A, the supply is increasing relative to the previous test in areas number 15 and 16. So why would that be happening? Well, as we know, and as Lee actually explains here on this in this text, this increase in the volume signature could also suggest just a second. Would also suggest that there is not only increase in supply, but there is increase in the demand. So that's a given. But we know that, again, increase in the supply, as it was increase in the supply here, suggests what? Suggests retesting. So therefore, we know that the retest, the true retest, the successful retest, after which we should have a much better movement to the upside, should come with 2 points. One structural point higher low, and then the second volume signature, diminishing supply signature. And then at 24, we have that test. And that test is a lower supply test and a higher low structural test. So we finally have tested the supply that came here and then here. And finally, we're saying now the price is ready to move out. So that defines the timing of when the price could potentially leave the trading range. So I thought it was really cool how Lee, walked us through this on these slides. I wanted you guys to have this, and Lee, thank you for this work. There is more explanation here, so just go through this, and hopefully, Lee, you don't mind that I'm sharing this. I usually assume that whatever slides you sent me, whatever questions you sent me, it's okay to put them into the context of our discussions, because usually the questions that you ask are on the minds of many students. It's just been proven from cycle to cycle that if you have a question, most likely somebody's thinking about the same thing. So please do send me the questions. Please do send me work like this. It excites me to see that there is so much deep thinking and refinement on this material. Okay, and then a couple of questions here from Lee. and then we're going to go into the exercise. Um, so an assumption here that the professionals will be carrying out mean reversion trade into the overbought areas above the institutional value zone. The professionals here will still be considered as strong hands. That's the question. And let's just think about where the value is for the professionals here on this particular chart. So this is Apple, and this is a daily chart, just as a reference. So we defined the institutional value by how? Well, we saw some buying here on the change of character, these two bars, and then after that, this was more of the selling that came on this bar, so we don't want to include that. And we're thinking that this, anything above is overbought, anything below is oversold, kind of like the same distance that we have. So somewhere in between, in the middle, this is where they really like the value here. So anything that goes below 70 cents, they would be buying. So that's why we see how the price recovers really quick out of these oversold conditions. So think about the professionals and mean reversion trade that they're gonna do. They're gonna identify those oversold, overbought conditions, and they're just basically gonna buy at the short-term oversold condition, and then they're gonna sell at the overbought condition. And they are just basically recognizing a trading range condition. Now, this is one thing that people might forget about mean reversion trades and how professionals using that. Because a mean reversion trade in the trading range is going to look different than a mean reversion trade in the uptrend. Right? So we know exactly how this happens. Now think about what happens next, right? So buying and then selling and then shorting again on the mean reversion trade, and then this becomes a loss for them. And once this becomes a loss, that dictates a switch in the definition, in their minds, in the definition for the environment. Why? Well, because now that this is a loss, this just basically tells professionals that this trade no longer works in this environment. So therefore, most likely, we are in a different environment. What environment is that? Higher highs, higher lows, an uptrend. So in the uptrend, the mean reversion trade is going to work in a slightly different way. I think we've talked about this, right? So overbought condition, oversold condition, both are short-term. So long-term uptrend, short-term oversold, short-term overbought. So mean reversion trade in the overbought condition is going to be technically executed the same way. They're going to short into the overbought condition, but it's going to be in the definition of a longer-term uptrend. And then their move to the downside, their target is going to be defined by the short-term oversold condition. And then again, they're going to be buyers in the short-term oversold condition, and then they will be sellers in the overbought condition. So that's how this mean reversion trading is going to change for the professionals, because they also will be looking at the difference in the environment. Okay, so let's see what happens next here. If these professionals are they what? Strong hands. Okay, yeah, it looks so different for some reason. If these professionals are strong hands, and we're going to assume that professionals are going to be almost always strong hands with an exception of this trade right here. So it's only on the change of environment. This is where they're going to be wrong. Everything else, if they define the environment correctly, then it doesn't really matter. And this is actually one of the best consistent trades that you could have, that you could possibly have. Think about this simplistic system. Step number one, define the environment. Step number two, define short-term extreme conditions. Step number three, execute. There is nothing else to this strategy. I mean, there might be some variations on like extreme extreme price movement, extreme climactic movement in the volume signature, and so on and so forth. But this is how simple trading could be. And obviously, this simplicity only comes after a deeper understanding of how the market works. So sometimes to be that simple, we have to become more complicated first. Okay, so if these professionals have strong hands after the mean reversion trade, they will be reaccumulating their shares again in the value zone as well as the oversold areas. And I think that we went through this, right? So they're going to make this trade, they're going to sell here. This is going to be a loss, and then they're going to, again, do a different mean reversion. They're going to sell here, they're going to buy here after the trend has been defined. Explanation about the party which is responsible for MRT so far was referring to the professionals only. Does it mean that ITFs or the CO not participating in conducting mean reversion trade? Yeah, I definitely see the point that you're making, Lee, and it's true. Yeah, both CO and ITFs could be involved in that type of trading. Maybe it's not going to be necessarily a predominant strategy, because the CO strategy is all going to be about big secular and business cycle moves. And then ITFs are going to be all oriented to trend following. And then professionals are going to be doing the mean reversion trade. So the reason why I kind of group them together like this is because those are different types of trading that is available to institutions. And even the CO could be at some point conducting those type of trades, you know, within, let's say, the context of the trading range. They might be selling here some of their position that they've acquired at this point just to take the profit and be profitable for that position, because the risk is always like this looming question is, how am I exposed to the market? You know, how's my portfolio exposed to the market? So they might take some profit, and that could become a mean reversion type of profit taking. And they could even have some hedging mechanism, which is the mean reversion trade by itself. To me, what was important is just to understand that there are institutions that operate on a very, very high time frame, and then there are institutions that are definitely following the context of an environment in both ways, whether it's trending environment or non-trending environment, or a trending environment, but you still, the trades are kind of like in the uptrend, downtrend. In the mean reversion trades, they are going to be more of isolation trades between the short-term oversold and short-term overbought conditions. All right, great. There was one more question. Why don't we do this, Lee? Why don't we leave this for next class? I think we're going through too many questions today. And instead, and Lee, by the way, thank you very much for all this work. And instead, what we're going to do is, let's jump to the exercise. We have about 25 minutes or so. So I want us to do a little bit more. So let's just see where we're going to stop. Maybe we'll go beyond that. Maybe we'll go beyond 5:30 today. I need a volunteer, and the first thing that we're going to do as we come back to the group exercises, we're going to look at the trading range from 33 to 37, and then we're going to discuss it. We want to understand what the bias is here. We want to understand you know, what phase we're in. We want to understand what might happen next, and so on and so forth. So volunteer, just say yes, and I'm going to unmute you. We should have some music while I'm waiting. Doom, 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 doom. Okay, let's go with Rick. Hey, Rick, how you doing? Rick, are you there?
Yes, can you hear me?
Yes, yes. Some noise, background noise a little bit, so maybe you could just be a little bit closer to the microphone. That would be great. Okay, and
Yeah, I'm
then,
getting settled.
okay. And then I think that we stopped at 32, 33, right? About this area right here, right?
Okay.
And so what I want to quickly repeat is 31 and then 32 and then 33. So on 31, let's quickly talk about 31. What is effort doing?
Efforts increasing.
Yes, effort is definitely increasing. This is the highest volume signature. So we've talked about the effort, you know, what it means. So if we would be looking at some analog bars, the bars that are overcoming the point of the resistance, like this, like this, like this bar right here, maybe this bar right here with this resistance here. So look at all of those bars and look at their volume signature. In all of these cases, there is some kind of increase in the volume signature relative to what we've seen before. And that's what effort is all about. Effort, I'm sorry, this one right here. Effort is more about the difference, right? So we've had a lot of effort to the upside at this level right here. And that's the effort of the demand that's coming in and trying to produce a new commitment in the direction of the bias. And whether it fails or whether it doesn't fail, it doesn't really matter. We just want to measure how effort changes. So now look at
Okay.
how effort has changed here. This is the difference in effort. So we definitely
Okay.
see that the effort has increased tremendously. What is the result?
Yes.
Rick, what is the result? Is the result increasing as well?
Um,
Bar number 31?
yes, I would say it is.
Yeah. We see
Yes.
that the spread, this is the largest up spread that we have seen so far. So the spread is increasing. The close is in the upper part of that spread, and we're committing heavily above the resistance level of bar number 30. So a
Okay. Right.
definitive increase in the result as well. Bullish or bearish?
Bullish.
Bullish. I'm glad that you said bullish because obviously I'm showing you what happens next. But short term, we are still bullish at this point. Now, even though we are bullish, what is the hesitation that we have about bar number 31?
Um, I think that probably that huge increase in effort
Yeah, the volume
with
is
respect to,
the volume is so big. We know
right.
that demand is increasing, but what supply is doing?
Um, Supply looks like it might be diminishing.
Okay, so let's look at the supply from a different perspective. Let's look at the supply on this bar and This is the
Okay.
volume signature. And then where do you think supply came before this bar?
Um,
Obviously, it came probably on some kind of reaction on the previous bar, right?
oh, you mean, yeah, supply from
Yeah, where's
on
the
31 opposed to 30?
yeah, so where's the evidence that
Oh, some kind of news or something.
yeah, so look at the bar number 30.
Just, yeah, just the spread and the volume increase.
We see that
It looks like some,
bar number 30 has a supply tail. So supply tail is going to be the difference between the high and the close, and we see that it goes below the 1/2 of the spread. So we know there was some selling on the intraday basis right there. So we don't have to
okay,
go
right.
that far away, to see the presence of supply on nearby bars. So think about the supply that we have had on bar number 30, right? It's still a bullish bar because from close to close we're still positive here. But then some supply came here at the end of the session. So out of this volume signature, we probably seen what? Some demand, some supply? Maybe something like this, maybe like 50-50, maybe demand is slightly better, so maybe like 60-40, right? So demand and supply.
Okay,
Now look at the next
okay.
bar, bar number 31, and look at the high volume signature. Is it all demand?
No,
No, obviously not. Okay,
no.
so if it's not all demand, then uh, could you think about the levels of the supply that we might have on this bar? Especially knowing what comes next. So we know that there is some kind of
Yes.
stopping action that is
Some
happening here.
selling. Yes, we are.
I'm sorry,
We
Rick.
know that's coming.
Okay, so then the next question, is supply increasing on bar number 31?
Yes,
Yes, so we know that supply is increasing.
yes.
Could we visualize this increase of the supply on this big bar? I mean, where would you put the supply in? I mean, demand is definitely dominating this bar, right? So demand maybe like what, 80% and supply maybe 20%, something like
Okay,
this. Would we say that?
sure.
Okay, so let's just say maybe supply is just that right here. This is, well, actually, let's do the demand first. Let's just say that maybe demand is all of this. This is all demand. And then supply is just this. So relative to the previous bar, where we see supply is like this point right here. Let me take another color. Like supply is only this. Now supply is this. Demand is still dominates supply so much. But is supply increasing relative to what we've seen on the previous bar?
No,
Look at the
I
level
would
of the
say it's
supply
not.
on bar number 30 and compare it to the level of the supply on bar number 31.
Oh, just relative. Yeah, the supply is increasing.
Yeah, and that's the whole point, guys.
Yeah.
And that's why the volume signature that we look at could is so confusing because we don't understand the relationship, the proportion between demand and supply. I'm going to show you some of the tools later on when we're going to go into more advanced studies and specifically in practicum. We study the market profile that helps us to identify supply and demand a little bit better. We also study the up and down net volume signature a little bit. It requires specific tools, but you could definitely do that as well. And it shows the picture more of like this than the volume signature. So that's why you know, a lot of the traders just don't recognize that on this type of bar, supply is increasing. I mean, relative to demand, it's definitely lower. Demand still dominates, but that increase of the supply suggests some selling that is happening already on this bar. Institutions are selling into the strength of weak hands on this bar. And that suggests that they're going to still keep selling if the price goes high, because it creates more and more overbought condition, overvalue for them for this particular stock. So they will be selling. Okay. Well, Rick, what happens on bar number 32 then? What is happening with effort? Rick?
Effort is decreasing.
Decreasing, effort to the upside is decreasing, and then the result?
And the result is decreasing.
Okay. Bullish or bearish?
Bearish.
Bearish. Short-term bearish. Absolutely. Because we see that the effort to push the price up is lower. What does it mean? This means that the demand is going down. Yeah. So on the previous bar, if we had demand signature as all of this, so now maybe on this next bar, and we see some selling at the beginning of the session right here. So maybe demand now is something like this. So even though this bar looks bullish, we are seeing deterioration of the demand on this bar. And by the way, supply is not necessarily growing on this bar. It could be the same, it could be slightly lower than on bar number 31. But because demand starts to deteriorate, that's where the price is kind of like not capable of producing the same type of result as on bar number 32 or 31. Okay, so we're seeing on bar number 31, supply is coming in. On bar number 32, demand is diminishing. Okay, so bar number 33. Okay, bar number 33, what happens there? Let's talk about the effort to the upside and the result to the upside. What is happening with the effort? Slightly higher effort to push the price up, right?
Yes.
Or maybe the same. And then what about the result?
The result is down.
Yeah, well,
Down,
definitely we are not doing
down, down,
anything
down.
with the progress to the upside. So therefore, the result is going down. So on the same effort, instead of a better close that is above the close of 32, the close at 33 is to the downside. So a negative result. So bullish or bearish?
Bearish.
Absolutely bearish. And now we're seeing that there is a synchronicity also between the attempts to on the increased supply signature to go down, and for the first time it actually goes down. So that synchronicity suggests the timing for the beginning of the move to the downside. All right, so so we're kind of seeing how change comes so ever gradually. Again, let's go through this. Increase of the supply on 31, invincible to amateuristic eyes. Rick, there is a lot of background noise. You're probably close to the microphone with some of the things that you do there. Then on 32,
Yeah,
there is a decrease in the demand signature. And then on 33, we are trying to continue to the upside, and we're seeing how supply is starting to come in, and then we see also the result to the downside that suggests the synchronicity between the effort and the result. And that suggests a timing for us for the beginning of the move. Okay, great. So 33 will be labeled as how, Rick?
Buying climax.
Buying climax. Okay. So then where is our next Wyckoff point? Where is our change of character or automatic reaction?
I call the automatic reaction at 35.
Okay. Okay. So this
And then
reaction should be,
secondary.
okay, secondary test, somewhere in between, right?
Right.
Okay.
Right. And then phase A.
Phase A. Okay. So look at the change of character, guys. This is the distance that we traveled to the downside. Is this, Rick, is this the largest reaction since we had the low at 1516?
Yes.
Yeah.
Definitely.
Everything else kind of slightly under. This is definitely the largest distance. So downswing increase that we see. Okay, so that suggests, change of character suggests what?
Trading range.
Trading range, a change of environment. Okay, so now once we're in the trading range, we want to identify a bias. Okay, let's keep this in mind. And how would we define the boundaries of this trading range?
The high of 33 and the low of 35.
Okay, great. So we defined the resistance and the support, and we are saying that the price should, majority of the time, consolidate between these 2 points. Okay, and we are putting here phase A. All right, let's talk about the bias. Let's talk about the bias from the point of view of the supply. We just studied this today. So what can we say about the supply in phase A?
Um, there was a supply increase in phase A.
Yeah, and we could even take these 2 bars here as well, this one and this one, because we know that there is an increase of the supply at 31. We know that supply is still somewhat high at 32, just because the volume signature is high. Okay, so, and then look at the bars after that. What is the difference? I mean, like, this is the first time when I see here 1, 2, 3, 4, 5 bars in a row where there is a selling. Have we had this before?
No.
Maybe
No, that's
here,
first time on this
but
chart.
this was just 3 days. But look at also the volume signature, right? I mean, this is a different type of supply that comes. This comes at the end of the move into the climactic action, and then it produces the move to the upside. This supply is different. That comes after we already had some kind of movement to the upside. So the context is different, and it's much higher. It's probably like times 2.5, and it lasts 1.5 times more than the supply that came at the end of the down move here to point number 6. Okay, so what would that suggest? I mean, there's big difference in
That would suggest that
supply signature.
looks like there's a lot of institutional selling and weekend buying.
Okay, institutional selling for sure. Who would be presenting the market with so much supply on this 7 bars if we take 31 and 32 into the same area? Yeah, only institutions would be selling like this because this selling is heavy. That's number one. And secondly, it's consistent. So think about these two words. Heavy selling. Heavy defines the institutional presence. And then consistency of how they sell. For 7 days in a row, they sell, 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 sell. Does this look more like an accumulation or more like a distribution in the way how they sell?
Um, an accumulation.
A reaccumulation? Okay, so we're talking about institutional
Yes.
selling, we're talking about heavy selling, we're talking about um, consistency of selling. So not only they are selling a lot, they are consistently selling throughout, 7 days there. We're probably talking more about the distribution rate, right?
Oops.
So I want to repeat this so that we would get this correctly. Look at the volume signature. In this area, this is the volume signature that has both the highest volume spike and that has the most consistent selling that we have seen, on this chart. We have selling here at number 14. This is just one bar selling. Remember, we've talked about this today. What's the difference between consistency of selling and then just one bar selling? Well, this is it. This is how it looks. At 14, we are being sold, 13 as well, so you can say 2 bars. And then after that, there is diminishing selling in this whole formation. At 31, 32, 33, 34, this looks different. This looks so much more selling that comes into the market than at number 13, 14. So we should be thinking that maybe this is the distribution that is unfolding just because phase A looks so different than phase A at number 13, number 14. So at this point of time, even though we are kind of like speculating, we are trying to deduct whether this is a distribution or reaccumulation. We're saying that this is our assumption. And this assumption either needs to fail or we need to confirm it. And why is this an assumption? Well, because there are some other traits that are still not distributional traits. Rick, what do you think is not being shown to us here? If this were a distribution, what do you think is not being shown to us? What we would like to see maybe in phase A for the distribution. We've discussed volume so much. How about the price? What would the price preferably do? Maybe be a little
It
bit
wants to
more.
go down.
Yeah, wants to go down right now. Yeah, so it would be more aggressive to the downside. We still don't see that, right? Because, and I think that there is a comment here from Milish. Look at the uh, look at the distance between 14 and 15. Compare that to 33 and 35. Kind of looks the same, if not even smaller, slightly smaller. So we still don't have the result to the downside on this consistency of selling and on high heavy selling. So therefore we are expecting a better picture as a confirmation of the bias to the downside. So far it's not there, but it definitely catches our eye that there is so much distributional volume that is coming in. Okay, so now that we have an assumption on the bias, Let's see if we could confirm it. You mentioned a couple of things. You mentioned that the strong hands are selling. They are selling from 31 to 35, and then weak hands are buying basically on the same bars. And we could see this through the tails of all of those bars. If we would build an intraday picture of this, think about this, bar number 31, this is the close. Then the next bar, there is a slight gap up. Most likely there is some kind of selling just because we had the selling into the close of bar number 31. So we're selling first, then going higher, closing positively. This is 32 close. Then we are slightly gapping down, and again, most likely with the gap down, the first momentum is to the downside, something like this. Then we go up, and then we are being sold and closing below the previous day. So this is 33 close. Then think about the next bar, 33 and a half. So a slight gap down, attempt to go up, continuation to the downside, and attempt to be bought. Then the next gap down, and slightly maybe misrepresenting this. Okay, so the next one, gap down. With the gap down, probably first move to the downside, attempt to go up, and then such a big sell into the close. So this is 34. And then 35 opens up kind of at the same level. Maybe it goes down first, maybe it goes up first. I don't know exactly here. The overnight action does not give me a lot of indication on the momentum. I probably would be thinking maybe just trying to go up again, going down, something like this, maybe in a slightly different picture. But you could see even from this, this is our kind of like best guess on the intraday structure. So what do we see here? We see how there is selling, 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 a lot of selling here, a lot of selling here. So those are institutional selling. And then, as you said, the weak hands are buying. So they are buying. They are buying on the way up. There is some value here. Then there are buyers somewhere here as well at the same level. And then there are buyers again at the same level. So 3 attempts to buy here, here, and then here. All of them are failing just because the price after this kind of consolidates and goes down. And then weak heads are probably trying to get back in right here. So that's the intraday picture. That's the strong and weak hands, how they're interacting at this spot. And please notice, once we're done with this, this is the exchange of shares that happens in phase A. Then what happens afterward? I mean, like going into this area right here, nothing, right? Because CO might have sold and becomes inactive. Weak hands bought and they are inactive as well. And mean reversion trade here is basically off the lows, and it's not an extremely deeply oversold condition, so they might be waiting for a much better conditions here to activate this trade. So we are going into the period of inactivity, and we're seeing this in this area right here between 35 and 35 and a half. Oh, a mistake here. 35 and 36. Volume signature goes down. Okay, so the next thing that should happen is for us to understand, how the trading range is going to unfold. So I'm going to leave you for a second just to think about this, and I'm going to step out for a second for just 1 minute. I want you to think about what happens at 36 and 37. Who's doing what, and what it means for the trading range, and how it should be unfolding at this point of time. And I'll be back in a minute. Thank you, guys.
Okay, so this is decrease.
All right, guys, I'm back. Thank you for that. I just had to get that package. All right, so what are we seeing here, Rick, with 36, bar number 36?
Got a pretty large volume and a pretty good spread.
Okay, so effort is doing what?
Effort is increasing.
Increasing. And it's increasing substantially, right? So it's increasing over this bar, over this bar, this bar, this bar, any up bars since 33. This is the largest spread, and this is the largest effort. So both result increase and effort increase. Bullish or bearish?
Bullish.
Bullish, definitely bullish, short-term bullish. Now, what was the intention behind this bar, by the way?
Probably to overcome the
Mm-hmm.
highs there between the 235 bars.
Yeah, the 235 bar is unbelievable.
Yeah, right.
How I
Yeah,
missed that
right. Yeah,
right
so
there.
right
Yeah,
there.
yeah. Did it do
Yeah.
that?
No.
No. So
It
even
touched it
though it
and
looks
but
so,
then
say again.
Hmm. No, it just touched it, but it didn't, it closed below it.
Yeah, the close is right here. The close is below that level of intermediate resistance, the level of commitment that we wanted to see from this bar. Just think about the effort. It's one of the highest efforts on the chart historically. So, and that was the intent, you know, to overcome this resistance by an intention by the price, not by the CO, not by weekend, but nobody. It's just we're saying that the price, the intention of the price was to commit about this level, and it didn't. So even though we have a bullish interpretation on the resultant effort, we have a negative interpretation on the intention, which kind of puts us in a doubtful situation that this is going to be a good rally. Okay, well then bar number 37 comes. So this is number 36. So 37 comes, and what do we see there? What is happening with effort?
Effort is decreasing.
Decreasing substantially. And then what is happening with the result to the upside?
And the result is decreasing.
Substantially. So decreasing effort, decreasing result, bullish or bearish?
Bearish.
Bearish. Okay, so short-term bearish. Now, let's think about what is happening here on bar number 31. Let's kind of build those analogs, and 32, and bar number 36 and 37. Do they look the same to you, Rick? And you have to compare the structure of the spread, the closes, and then look at the volume signature. Think about in the context of what the price is trying to do there. In both cases, tries to commit to the upside, right?
Yes.
So in the first case, we do commit to the upside. In the second case, we don't commit to the upside. But price structure-wise,
Correct.
volume-wise, it looks somewhat the same. We have bar number one that has this momentum characteristic, and it happens on the increased volume signature. Bar number two shows diminishing qualities of this effort to push the price higher, and the volume starts to diminish as well. So the same price and volume structure, the same signatures. The only problem here is that in the second case, we are not committing above the resistance. In the first case, there is a clear commitment above the area of the resistance, and it's a substantial commitment to the upside. In the second case, we are really not committing above the resistance that we need to. There is no clear path for us. So, Rick, what do you think this means?
It looks bearish.
It looks bearish because
Yes.
the effort to the upside between these two analogs is definitely diminishing. The intention is not being fulfilled in the second case, and we're seeing that, and that just basically tells us that the result to the upside is also diminishing. So diminishing effort with no result, bullish or bearish?
Bearish.
Bearish. Now one more point and then we'll make our final conclusion. So this one short-term bearish, well actually not just short-term, for this whole structure this is bearish becomes because of these two attempts to go up. Now let's think about selling itself. So we said that they sold on 31, they sold on 32, they sold on 33, they sold on 34, and on 35. All of this has been selling by institutions. What do you think they are doing here at 36 and 37?
they're inactive.
They were inactive between 35 and 36. Then the volume signature has increased, so they are not inactive anymore. They're doing something. So we're trying to define 36. What is it that they are doing? Think about the intention. The price needed to commit the bar, but it didn't, so therefore,
They're selling.
yeah, they're selling again. But they're selling less. So this is the situation where they sold initially and then they don't have to sell as much in the second case to produce the result of failure. And that kind of gives us an idea that also about the demand. If they don't have to sell so much, then this suggests that demand is becoming poor. Demand is decreasing. So with this, look at the next bar. The next bar, let's call this 38. Let's not call it 35. So the next bar, bar number 38, this spread
Ease of movement.
is increasing. Yes, the close is very favorable to the downside as well, and yet the volume signature is going down, and we're committing below the last bar number 37, and we're committing below 1/2 of bar number 36. So this is a commitment to the downside. So with this commitment to the downside, and with the poor demand, we commitment to the downside on decreasing volume signature. This is an ease of movement. This is what Rick said, ease of movement. And this ease of movement suggests that we're kind of done with selling. That's number one. Done with selling, at least for now. And then secondly is that demand is poor, and that suggests that demand is in weak hands. And that diminishing demand signature also suggests some kind of timing, that it might happen now. It doesn't have to happen later. So at least at the minimum, we would be thinking that this ease of movement should produce maybe a lower low here. And if it's going to produce a lower low, then could we be either in like extended trading range like this, or could we just go down here? So we'll just have to see what's going to come next, how we could confirm all of this. By the way, could we think of this trading range as like a concluded trading range for us? What do you think, Rick? Or should we have more duration to the range?
Looks like there's going to be a little more duration to the range.
But think about this. They sold here, right? So selling was increasing a lot, and then selling is going down, and yet the result to the downside is increasing, suggesting an ease of movement by itself, suggesting that demand is low, so and therefore the timing of maybe now. All right, well, why not just look at this, what has happened next? So let's just see, and then we could just comment on that. Okay, so that's what happens next. And we see how the downtrend develops from 37 to 40. If we are thinking that the trading range needs to develop here, we might miss this trade. But you cannot miss the exit on the trade that we were in, right? So if we were thinking that we were biased here, and then we were biased again here, somewhere here, then we are definitely sellers on this bar. This is our capitulation bar. This is the latest bar that we could possibly identify where we're going to say that that's it. The trend is done. There is a break of the trend, and we are out. Now, we should be out much earlier. This is the last exit for us. and we're kind of back engineering this. Our first exit should be in the area of 31, 32, 33. And this is what we're going to call our Wyckoff exit, because we're going to discuss other exits as well. So our Wyckoff exit. Then the next exit is going to be after the change of character on the way up into the secondary test. So we want to exit somewhere here. This is our second exit. Our third exit is going to be on the reversal of the last attempt to go up, number 3, and this is our number 4 exit. So as you could see, this is how we would be scaling out of the position. We don't necessarily need to close the position right away. We could wait out and see, you know, what kind of change of character we're going to see. And we're seeing that the change of character here is not that decisive in terms of the result. You know, we could be thinking there might be a reaccumulation here. The only clue is in the volume signature, at least at that point. And then as we go into 36, 37, then we're seeing how there is another failure, and at least this failure suggests a lower low. So a big question, a tactical question for us, if we're going to have a lower low than 35, what's going to be done with the trend? And most likely it's going to be broken. So if the trend breaks, what kind of reaction we're going to have to the break of the trend? Most likely we're going to have some kind of further capitulation that's going to lead to an established downtrend. So we want to get out somewhere, you know, somewhere here, and the latest here. All right, guys. Rick, thank you so much.
Okay, thank you.
Good job. And just let me quickly look at some comments. Are supply signature schematics that we've studied earlier applicable to reaccumulation? Yes, Nalesh, yes, absolutely. Okay, so homework. Homework is going to be to look into this area, analyze it, and then come to the next class with the analysis of all of these points up to 57. You have to analyze each bar, you have to analyze each swing, and you have to give me a conclusion as to what kind of next move we could expect from here. That's assignment number 1. Assignment number 2 is always watch this recording again, specifically with the exercise, and this is exactly what I want. I want that exercise, you know, to go into your notes, and send those to me, email those to me. All right, I think that's it for today. Let's see what else. Eric is saying, what about the upsloping channel? You did draw the 34, seems like an upthrust in the distribution. Okay, so we're talking about this. Yeah, so it's not necessarily an upthrust of the distribution, right? Because it's actually a stop in action. So this is more a stop in action that defines an overbought, overthrown condition, and therefore suggests that this is a buying climax as a stop in action. What we didn't talk about with Rick is when we look at this trading range, look at these two rallies and think about the definition of a first point of excitement and then a second point of excitement. And usually the second point of excitement is going to come where? It's going to come in phase C, either on upthrust of the distribution or on an attempt to upthrust. So you could see that there was an attempt here at 36.37 to commit above, to produce an upthrust. and yet it failed. And the failure of the upthrust, which basically leads us to the conclusion, now that we see the whole thing, that this was phase C, and this becomes a low or high LPSY, last point of supply. And then we're a little bit puzzled as to, how to label this whole thing. So as we've noticed, there were quite a few attempts, to go up here. So here are your secondary tests. So this could be your phase A, phase B, phase C, then phase D, right here, sign of weakness, LPSY, and then off we go into phase E, the downtrend. All right, so that would be the labeling. In terms of the slope, we would be putting the slope actually down like this here, and then we would be looking at this sign of weakness and LPSY here, and look at how it comes exactly to this point. So it would be more of the downslope here rather than an upslope. All right, guys, good class. Again, I'm glad that we are moving along both with the material on the volume. We have all those lectures, type of hours, and then we exercise. We go into our drill exercise, and we are trying, to repeat the same process over and over and over again. So next class, do your homework, and let's see what's going to happen next. All right, guys, thank you so much, and have a happy week. Thank you, guys. Bye-bye.